most people don't really appreciate the fact that the average home ownership tenure in the home you live in is about 4 years on average, which means you have not actually clipped. Whether or not you're renting from a man named Steve or Wells Fargo, you're still renting your home if that's what you're doing. 50-year mortgage is just a longer rental cycle.
So tell me what's happening in the new year down in Huntington Beach, Chris.
Well, first of all, pleasure to be with you. Thank you for
Yes,
having me.
my pleasure.
What is happening in Huntington Beach other than the weather being great and the ability to, if you so choose, play golf or even jump in the cold Pacific Ocean? It is a wonderful place to be. But the new year has started, I would say, interesting.
Okay.
So we came out of last year, especially in what I do in kind of capital raising and helping companies grow. And it's this kind of 50-50 shared view of it's going to be better, but we just don't know how yet. And then all of a sudden we get a little Venezuela mixed in. It's like every year there's just something to start the year that gives us all this fear, uncertainty, and doubt. It's wonderful.
Uncertainty and doubt. Yeah. Confusion and chaos and anarchy in some people's courts, right? Yeah. Exactly. Why not? Just jumble it up. See what the year holds. Just jumble it up.
Just throw it right in. We'll do tariffs last year. It's like I didn't have Venezuela on the bingo card, but here we are.
No, well, I didn't have 2020 on that one either. So hey, we're now 5-6 years into. Let's just do whatever the heck we want to do and just see what happens. You know,
yeah, see how resilient the American people are.
Yeah, let's just go invade Greenland too. That'd be cool. Let's just see what happens with that. Why not? Just throw caution to the wind.
Just let's do it. That's awesome.
Has it affected your business at all, positively or negatively? Any of this stuff going on in your business? Because you guys.
If I look at the roadmap of, and you brought it up from 2020 to today, right?
Sure.
I'd say you're kind of rolling. You got to take some punches. You got to take some good. Yeah. But overall, and I had a great meeting this morning on this with a colleague. Capital markets and just general liquidity and venture and PE kind of stagnant, and it shouldn't be a surprise, right?
No, not too much. Fourth quarter kind of happens a little bit like that, right?
Yeah, but I think even more macro, if you take a step out, you're not seeing the same type of M&A activity as you were in years prior. And, coming out of 21, obviously we talk about this a lot. That was a very fun but unrealistic view of this market.
Yeah.
However, I think everyone who had their very, very dirty crystal ball would have said it would come back a little bit with a little bit more fervor than it has, right?
Yeah.
Companies aren't going public at the same rate. There are, in that conversation this morning, there are some amazing companies that are sitting at $10, $20 billion valuations that are saying, I'm going to stay private. This is great.
We're just going to hold on. Yeah. Yeah.
And so there's this piece of it causes this liquidity crunch. And so you need this cycling of capital to happen in a, fairly good tempo to really support a lot of what's happening in this private investment community. It's not to say there aren't great deals getting done, but just there's I'd say a liquidity pinch in a lot of cases where people are in deals for years longer than they'd planned to be.
Mm-hmm. That's not, it just sounds cyclical in nature, isn't it? How long have you been at this game?
It depends on when you want to start the clock, right? So early in my career is in real estate investment banking, and I chose to do that in the 2007, 8, 9 range. So that was a fun time to be out doing mezz debt and growth and income funds when the whole world is imploding in real estate. I spent the better part of the next decade as an operator, right? Growing companies, had a few exits, had raised capital for some funds that I was doing with another GP. And then I joined the firm here at Slico back in January 22. And so, I joined right at the fun time, let's say post-COVID, right? When, we're going to have some fun with some interest rates and we're going to have some fun with some uncertainty in tariffs a few years later. And now, let's see what World War III ends up being. Sorry, I didn't mean to be that heavy, but we'll just throw out just a little invasion of another country. And so, there's always something. So while I would say cyclical in nature, absolutely you can point back, but I'm not sure I can really recall a time where it's been this stagnant. And that isn't something that I think people should necessarily fear. There's great.
Oh, it just means timelines change. Perseverance and patience kick in a little bit, right?
Yeah, and I think there's a responsibility for not only the executive teams, the operating teams at these companies, but also certainly their boards and their investors to be more prudent than they ever have been. Now, I will say, to your point, if I go one step higher and we look at capital markets, for example, right, there are times of revenue, meaning of growth, and there are times of yield or profit as things have value.
That's right.
Right. And
Planting and
so
harvesting.
you got it. And so I think we're at a time of, and we have been, of yield being important. Now, with that said, I would argue that 2025 got a little wonky pricing in some growth metrics against some things, but to be expected. I don't know, man. This is going to be,
it is interesting.
It's going to be an interesting year.
It really already started off pretty interesting. I'm optimistic. I mean, it sounds like you are too, but it just the parameters by which that optimism has changed. And, you know, as entrepreneurs, we're blindly optimistic. Let's call it what it is, right? So we don't always see things from the forest through the trees. We try to. But I know that in the last year, one of the things we've been doing a lot of in our business is planting.
Yes.
Right. We've been planting. And planting means at certain periods of time, you just, you know, you're waiting for that great growth and you're hoping a storm doesn't come and kick things down while you're waiting for the harvest. We watched Little House on the Prairie at times when my girls love that show. You ever seen that one?
Yeah. Oh, yeah, I have.
Where he goes out and plants the whole farm and then it hails, right? Then he gets sick and he's in bed and he like wants to die and all this stuff. Sometimes that's what it feels like. There's a planting.
Yeah, and you know, as we're talking about this as well, there's I think it's a Chinese proverb, and I'm gonna mess it up, but
okay, go ahead.
I would implore people to look it up. Basically, it's, you know, this guy and his son's riding the horse, breaks his leg, right? And they're like, "Oh my God, I feel so bad for your son. He broke his leg." And he's like, "We'll see."
Yeah.
And then the draft comes by and he doesn't get chosen because he has a broken leg, so he doesn't have to go.
So he doesn't get drafted. Yeah.
Right. And exactly. Follow on story. It's always, we'll see. And so I think there's this piece of, when we look at 26, right? All this fear, uncertainty, and doubt and things happening. It's kind of like, we'll see. I think there's going to be some amazing opportunities that come out of here.
Yeah.
There always are. And when I look against our portfolio at the firm, there's some amazing things happening for companies as early as the next 12 to 18 months. And so
agreed.
When I look at that, I go, that is where we should be driving.
We're in the planting
phase. Does that mean
phase.
Does that mean that some companies are, 6 months behind where they were supposed to be on projected forecasts? Yeah, that's to be expected as well.
Yeah.
And so we keep working through that.
Corrections are always a normal part of a free market economy. And as long as it stays a free market economy, then we can see those things occur, right?
Agreed.
I think there's that concern where, entering a stage that some of it doesn't feel like a free market economy. But on the same hand, it's like, well, businesses are growing, capital is being projected to be deployed. There are concerns about how that's going to be, tariffed or other things. And so, okay, we dealt with the tariffs. That's, part of business now. For a product-based physical company that works, moves, has logistics and got product on ships right now, it's just one of the things we've dealt with. And those who panicked during that time frame, who were not cautious and optimistic and didn't see a macro view, panicked. Yeah. And that panic has caused a lot of people a lot of money. Some businesses have gone out. Others, like us, are trying to capitalize everything as fast as we can because the opportunity is going crazy. And I've got businesses that are so new that need the capital, that other capital creative financings are just like, you're still too new, but those are some amazing numbers. And we're like, okay, well, give us another couple months and we'll be there. Yeah. And so we're looking at how that grows. And I think it's just a matter of, you look at things long enough, when to panic and when to get concerned about other things and when to see optimism through negativity. Yeah. And I see lots of optimism right now where people are seeing negativity. I see the possibilities, that income from our country supersedes income tax anymore. That, we might actually see a time frame when we get 10% interest on credit cards and things that could be positive, and gas prices could drop $1.50. Yeah. Things that are going to fundamentally help power our country back into a state of greater economic opportunity than we've seen in a few years. Things that are being exposed will dark to light, the amount of fraud. You see those things being exposed, you realize things are changing. They have to change. And when they do, there's opportunity. You just have to be smarter about when and where you step in the opportunity.
Yeah. And what's interesting, and would be remiss if I didn't bring it up, even though it sounds self-serving to talk about one of our portfolio companies. But when we look at opportunity, you saw the administration come out and talk about housing and the lack of affordability in housing.
Correct.
And, you mentioned I live here in California, and it's not affordable here in California, as we well know. But there are companies that are trying to do things a little differently. And one of ours in our portfolio is a company called Bonus Homes They're actually what's called a HAP, Home Appreciation Program. And it's
Hmm.
to revitalize the middle class through a really unique way of buying and selling primary residential real estate. And
Okay.
so you saw Blackstone come out
Yeah.
and their stock dive once the administration
9%.
said no more buying and selling institutional SFRs or single family residences. But Bonus Homes sits outside of that because they
Hmm.
are not buying and selling anything. The way they've
Hmm.
built the instrument is they get to empower the middle class by still being able to participate in these homes on a move forward basis. And so they're defined as a HAP as well, something that Congress is going to have to really work with
Yeah.
over the next year. And that puts them in a really interesting space. And, when we talk about whether or not we're opportunistic or pessimistic in the following year, right? When it comes to things like this, everyone's happy that, these big groups aren't buying.
Well, yeah, it's the opposite of when people cry fascism, where they're pulling corporations out of the ability to overtake the minority or the public, and we're
Mhm.
going the opposite direction
Yes.
of corporate takeover, which is fascism. I just find fascinating that people can't see that it's being reversed, and it's a great thing. I don't want corporations buying up neighborhoods and
No,
renting the houses back to us.
no, exactly. Which I think from our perspective is why we put a large investment into this company, because they were
Yeah,
saying we're not them.
yeah,
Right? The middle
yeah,
class gets to
exactly.
participate, and the revitalization of that's going to be extremely
Smart.
important. And
It's very
Bonus is
smart,
right there
and it's
to
going to be needed.
capitalize on it.
It's going to be needed to keep people from having to rent everything and give an
Yeah.
opportunity to buy something.
Yes. And
Yeah.
so it's funny as we become more and more renters in this country, just
Mm,
general for everything, whether or not it's leases or
your car.
yeah,
So
exactly.
many features on stuff your car you're having to rent now. Like, that's ridiculous.
So I mean, ownership is important and
There's
being
ownership.
able to fairly do so.
Yeah.
And for a lot of folks, it's just not attainable anymore.
Yeah, and I am optimistic that it will become that way. I really am. Because I don't like maybe I'm, again, back to that blind optimism. Maybe I don't
Yeah.
want to see the possibility of it not happening because I have children and
Yeah.
I want to see them have an opportunity, on their, as much as their own 2 feet can carry them, I want to give them opportunities too, to, have a home and have a place to be. And it's part of the reason we've structured the way we structure our house and moved out of the cities and went to, acreage and
Yes.
live out here on, now 65 acres with our parents on 3 different properties that are
That's
combined
amazing.
here. And so I would look at that and say, well, could we not have 4 more out here? And yeah, we could. And that's the opportunity to build that out. And it's going to take time and everyone's going to have to collaborate, but it's a valuable part of a society that someone has a place to call their own.
Yes.
Incredibly valuable.
100%. And, I'm sure we could talk forever about urbanization and a whole bunch of other
Hmm.
things and where you work. But I think everyone was given this amazing gift, and whether or not companies hold true to it on this
Mm-hmm.
work remote and being able to work anywhere and
Mm-hmm.
really kind of structure things different. And I'm not sure we saw the full concentration move out, but we certainly saw a lot of people. And I
Yeah.
think quality of life goes up dramatically, affordability goes up. And I think it's all very important. But a lot of things have to change from a real estate perspective to really allow people that affordability. And a lot of
Yeah.
that comes with new builds.
Yeah. New
And
builds, opportunities. Yep.
you have the problem in states like California where
New builds are not on their agenda.
no, because you have a lot of people arguing against it from a home value perspective.
Right. Well, it's that catch 22 because now their 3-bedroom, 2-bath, dumpster fire worth $1 million is really not valued at $1 million anymore, is it? When you put in new homes, it changes that valuation, which is part of
It
that
does.
painful right sizing that would have to occur in those locations. Not that it's wrong necessarily, and I wouldn't want to be stuck in that place either if my home from 20 years or 30 years of mortgage payments was worth so much.
Yeah.
But then again, they could sell it. There's always
And
opportunity.
they could sell it. There is always opportunity. It's whether or not they want to.
There is. Well, that's the
Yeah.
tough part, right? That is. And how does some of these changes, how do you think this is going to affect what you're doing? I mean, 50-year mortgages. What is your take on that one, for example?
Ooh,
Is
I
that
think
off of the
already at
right?
the, it doesn't change specifically from the bonus perspective. It doesn't change, right? You're going to
Yeah.
look at a lower payment. I would assume, well, not assume, I know there'll be more interest baked in. So it just takes you longer to ever actually
20
buy
years
your
more
home.
ish or so. Yeah.
I think most people don't really appreciate the fact that the average home ownership tenure in the home you live in is about 4 years on average, which means you have not actually clipped
Is it really that
and he
low
bit.
now?
Yeah, it's about 4 years.
I thought it was more than that.
No, last data I saw was 4 years. So I
Wow,
always
4
make the
years.
joke, whether or not you're renting from a man named Steve or Wells Fargo, you're still renting your home if that's what you're doing. And
Interesting.
so
Was that a byproduct of the lower interest rates? And where you had such
could have
ease of
been
movement when there was 2-3%, mortgage rates where every 4 years you could upgrade to a new home or whatever, pretty easy.
pretty easy.
Yeah.
Yeah, when money's free, there's different things that happen. I would say obviously tenure being a lot longer now. If we were to
Yeah.
go out the next 4 or 5 years,
It probably would
right? With the exception of people that have to sell, have to move,
be.
right? But if you have paper that's under 3%,
Why
it
would
would be
you?
foolish,
Well, it's
right?
down to 5.9, I heard now, or somewhere around there. Is that where we're at? A little bit
Yeah.
better, but still, why would you move at a 3-4%? You're not gonna
No.
Well,
No.
you'd be silly not to unless you were forced to.
Correct. And so, 50-year mortgage is just a longer rental cycle, I guess, is the way I look at it, right? Like
Who ultimately does it benefit the investor?
what are you saying? What do you mean?
Well, okay, so I'm a homeowner, but I don't have a mortgage. But if I were to get a
Yeah.
mortgage, is it
Mhm.
one by which 50 years really helps me, or does it help the guy who I'm going to rent it from? Like if I were to buy from Steve, as opposed to
Yeah.
Wells Fargo, who's
Yeah.
like,
If you
well,
were to
there's a
rent
50-year
from
mortgage.
Steve, I would say it absolutely, well, so it's two ways,
Okay.
right? So are you a land baron with multiple properties and doing this stuff, right? And so you want to have kind of capital pools that you can refinance and pull from to do your strategy to do more. I would argue the 50-year no is not as good. But if I had a house where I could lower my payment by a third, which means I get more rental income, I
Yeah.
do not necessarily care,
Yep.
right?
Yeah.
Whether or
in
not, because I'm
perpetuity.
getting a better yield as an investor.
Mm,
I would still keep rents exactly at fair market. They're not
mm,
going down with that 50
no,
year.
no.
So
Yeah.
I'm just getting more yield on a cash on cash basis per year. My mortgage pay down delta is not really happening,
Yeah.
but my appreciation still is. So
True. So you could refinance quite a few of your properties under the 50-year.
yeah,
And you're going to hang
pretty
on
much
quite a long time.
pull the cash out up to a certain point, and
Yeah.
now you have a much lower payment. I think it would behoove people who may have had an arm or something come due and all of a sudden need to refinance right
Well,
into
yeah,
a lower
at 6 or
payment.
7, 8%. That would have been
So,
brutal.
but no, I mean, look, I would tell you that when it comes to this piece, I'll get over my skis quicker than most. I don't want to purport that.
Mm-hmm.
However, just logically being able to extend out, right? It's why the 30-year fixed was so great, right? I have consistent, understandable monthly payments on what this asset is going to do. And as long as I stay here, don't stay here, eventually it'll be paid off or it won't. And, when you look at the fact that, I look at my parents in their 70s still have a
Mm-hmm.
mortgage that they're servicing, right? So like the idea of having the asset free and clear, you can, and I've heard arguments on both sides. One is what a great opportunity to not have a monthly payment for your home.
True.
The other discussion is, yeah, but if you've got 3% paper, we could argue that's negligibly free.
Free. Yes.
Free. And
Yeah.
I now have all that liquidity to go do other things. So,
Yeah, there's
if
a
my
benefit to
house,
that.
what's that?
Well, yeah, of course, there's a benefit to that. I mean, if you're looking at your cash flowing versus borrowing someone else's money, keeping your cash, then yeah, it's a much different game.
OPM with a small interest
That
rate,
low
being
is-
able to take your cash.
Yeah, it's not it's a fart in the wind. We bought a new car, first actually new car in 19 years together.
Yeah.
We never bought new cars because it's a waste. But it's the first time we had an opportunity. The interest rate was like 4% on it, and I'm like, put a little money down and then just cash float it because it's going to cost maybe $3,500 in 5 years. Plus, it's a Section 179. It's a car we use for business. It's got the write-off. It's got all that stuff, and it's like that's just free money.
It's free money.
It is
And
a free
now
money.
whatever your principal payment would have been for the entirety of it, put it into something meaningful, but as safe as
Physical products.
good yields get, right?
It goes back into physical products.
Yeah. And what do we have?
Assets.
We have assets that make us more money.
What's the
And
component
so-
of that engine for both of us, isn't it?
It
Physical
is.
assets
And
that make us
I
money.
think that's where there's an old school mentality of when I pay this thing off, I am free. And you're kind of like, okay, let's assume we're back to that $1 million home, right? That you've
Mm,
spent 30 years paying off. So now you have $1 million sitting in an asset that, yeah, it's appreciating, but it's just sitting there.
it's not recognized until you sell it.
Correct. So if I were to pull out cash on it and hopefully have the capital to service it, couldn't I buy an investment property or two and have the cash flow off of it cover the mortgage on my
You
house?
could absolutely do that.
Oh, wait a second. Now I have 3 assets, a primary and 2 investment properties.
And what else?
And so
you
I
can
think
do?
there's these things no one's
You're-
thinking about how
Well,
to use leverage.
they
the
just
right way.
don't know, and they're hopefully today they're listening to this because they're getting it from you, and you could take that capital and obviously put it into some kind of inventory factoring, real estate, something that drives value and appreciates, and then write the difference of it off or borrow it against it for free, and you pay no taxes against, which is probably going to be a strategy I hope will change if taxes get changed altogether.
Yeah.
And you obviously turn something from nothing into something, but just setting on it is still nothing. It's that net worth appreciation of our grandfather's grandfather, which was great, but in our lives it doesn't make any sense anymore.
No.
And if
Not
you're
at
not
all.
going to sell it, then you're never going to realize it. It just becomes part of your net worth, but none of the value can be obtained until sold or at death or as some other event occurs. So it's really not true net worth, is it?
No, it's just a line item on a piece of paper that makes you feel good at night when you go to sleep.
Oh, and by the way, don't pay your taxes for 3 years and find out what happened to that 30-year asset you thought you owned that you didn't sell.
Exactly.
Don't pay your property taxes.
Yes.
Guess what? You're still renting the land underneath it. If we're going to be technical, we have to get rid of that actually to make this whole thing really legitimate, don't we? Or we don't actually own the land.
No, you don't. No, you do not.
Dude, we're covering a lot of stuff on today.
I know, right?
We're talking about the moon landing next, or where you going?
Let's go. My tinfoil hat's over there on the shelf. I go grab it.
Bring it out. Let's put some tinfoil on and keep moving. Some of their stuff is no longer tinfoil. This is reality.
It is.
It's just reality.
Well, you brought up and by no means am I a financial planner. This is not financial advice, but I will tell you, you brought up the 179 tax exemption, right? The accelerated depreciation on assets. It is something that I don't think a lot of people certainly know about. And
it just changed. It just changed. Did you see that? It's now 2 million.
Up to 2.5 million.
New announcement, just up to 2.5 million. Yeah.
That is
for small
huge,
businesses.
by the way.
Yeah. You want to explain it to everybody what we're talking about?
So the quick and dirty of it is you can accelerate the depreciation on a physical asset that you buy for your business. So, Neil, you mentioned a car, for example, right? Over 6,000 pounds, they call it a farm vehicle at that point. And so you can write off, essentially, I believe it switched from 100 to 80 back up, I think, to 100%. I've got to double
over 5 years.
Yeah, over 5 years, 100% of the value that you just received. So, or you just paid for. So if you bought a $100,000 piece of farming equipment for real for your business and you're in farming, you get to write that off fully. Top line taxes done, like you didn't make that income. If you happen to get a big truck for your business or happen to drive a truck like I do, you can write that off in the same way.
Yep.
But you can also do it for any asset. They do it typically for equipment leasing, or excuse me, equipment financing. They'll do it for anything really for your business that's a physical good and an asset that you can appreciate.
Service industry based businesses, people who move trucks, forklifts in warehouses, whatever else it is you're using can be considered as part of that inventory and general merchandise, which is now up to, or general equipment, excuse me, which is now up to 2.5 million for small businesses.
Which is huge.
It is very big. You small fleet vehicles, you guys in the service industries, maybe listening to this, run a small fleet of trucks for your at-home services businesses, just got a huge opportunity to take advantage of that.
Now, the one thing most people don't actually realize, and I'd be remiss if I didn't bring it up, is if you then sell that asset, you have to recoup those back.
Oh, yeah.
Or you have to recycle the next.
Go look this up, guys, so you know the boundaries of both rules. But yes, if you sell that asset within 5 years, it then can be taxable for the value of the asset.
Exactly.
So go look all that up, make sure you understand that, and talk to a tax accounting and planning person. Yes. Caveat, disclaimer. If you don't know one, you can leave it in the notes below on one of the channels and we'll tell you who we use.
Yeah, we have a deal at the firm, and I won't go too deep into it, but it takes advantage of this. We have a large pallet company, and so they make physical pallets. Physical pallets are assets that move.
Yeah.
You do sale leaseback and be able to enjoy the accelerated depreciation.
Smart.
From a tax perspective for our investors. So things like that.
Pallets too. You're all over the place.
We are. Yeah. So our firm, when we look at ourselves, we're a private investment firm. And I make the joke, what does that mean? It means nothing on purpose. Right. But if I tell you we're venture, you're anchored in venture. If I tell you we're PE, private equity, you're anchored in private equity. When you look at it, we build capital strategies for mostly family office and ultra high net worth individuals. Excuse me. So we have a venture growth equity arm that's deployed hundreds of millions of dollars in capital in 40 different companies. We do traditional private equity. We have the equipment leasing fund I mentioned. We do private credit. We have a couple real estate projects in development. We also have a full advisors team. Think of them as a management consulting team that can come in and drive value during this formidable time for these early stage and private equity deals. And then a wealth division as well. So as I tell you that, you're going, yeah, you're not a venture firm. You're not a private equity firm, right? We really have our hands in these different pieces, and we're able to put together opportunistic deals, both ones we invest in, as well as ones that we create specifically to help our investors really enjoy, whether that's tax savings or, some kind of upswing on an investment they make, or, great steady return per year on a private credit basis.
Well, we got to talk about some of that because there's some stuff that we're doing you're probably gonna be interested in.
I love that.
Should talk to you more about what Voltage and Cayman are doing in that respect. And those who are listening to this should check out you as well. You want to give them the link and call out real quick?
Yeah. So lycocapital.com. That's SOLYCO capital.com. And if you really need and you're watching, it's right behind my head.
Yep. Or in the notes below, or right now, if Danny's listening to this, put it right here. So our editor will stick it on here. That'll be on YouTube for those of you who are watching. If you're listening to this, guys, check out the notes. Go check it out as well. Yeah, money it's ever moving, man. It's always flowing. It's a river. And I know a lot of people at times who listen to these podcasts hope it just magically floats over and bumps into them. But more than often than not, you have to go find it because it's moving. And if you don't feel like it's near you right now, it just means it's not near you right now. That doesn't mean that can't change as it shifts and moves. And sometimes you just got to find ways to get in front of it. So if you're trying to get in front of capital today, this might be something you want to go check out with Chris, or go check out what we're doing in e-commerce. That's another way you want to get in front of money that's moving, because e-commerce and physical products are moving great. Real estate is going to be moving a lot more, I think, this year with changes in policy and finance and mortgage rates, and maybe even no taxation and other things. Who knows? The world is changing so fast.
It is.
Something's going to happen tomorrow. We'll talk about it, I suppose, as the time goes. But man, I appreciate you spending some time with me, sharing a good word, and just having a great conversation. I've enjoyed this conversation. I hope those who are listening have as well. And will give us a positive comment and thumbs up. And if not, leave some negative comment. We don't care. It just helps the algorithm. Shake and bake on this thing, man. Any last words?
Neil, thank you. This was great. This was great. Thank you very much. I really appreciate the time.
It's been fun, man. Guys, as always, like, comment, share, and engage. Check out the last episode. We always do guest sessions on Wednesdays, and on Fridays, we do our weekend review update. So check that out as well. We are now top 2.5% on all listen notes. So thank you for being a great listener and for being a part of the journey. And until then, we'll catch you guys on another episode.